Welcome back. You're watching our continuing coverage here from Davos 2026. Joining us now to talk about the state of the Indian economy, more importantly, the fate of India's banking sector, is Amitabh Chaudhry of Axis Bank. Amitabh, many thanks for joining us here in Davos. Always a pleasure to have you with us. Let me start by talking to you about both global growth as well as the growth of the Indian economy. In fact, IMF has just put out its report. They've hiked the outlook for 2026 to 3.3%, up by about 20 basis points, with 2027 global growth at 3.2%, which is steady. And for India, again, there is an upgrade by 70 basis points to 7.3% for FY26, and then 6.4% for FY27 and FY28. What do you make of both where global growth is at as well as the Indian economy?
Well, I mean, in spite of what is going on geopolitically, I think you have seen that a couple of large countries around the world have started demonstrating growth. Even the US has produced better numbers than what people thought when the whole tariff war started. As far as India is concerned, I think this forecast is catching up with what the local economists have been saying for quite some time, that India should be able to do 7 to 8%. I'm sure this 6.4% also should get upgraded over the period of time, obviously, if we keep performing well. India has done a lot of work on easing some of the fiscal, monetary and the regulatory constraints. They realize with the net FDI situation where it is that something has to be done urgently. So they have been taking pretty radical steps over the last 6 to 9 months, but I do believe more need to be taken if we have to upgrade this forecast of 6.4% and more than the rest.
I'll come to the measures the government can or should undertake to try and draw in more foreign direct investment, but let's talk specifically about the banking sector. I mean, it's been the clear outperformer from a market standpoint. It's also been a big sector where FDI has actually come in. We've seen both financial as well as strategic deals in the banking sector. What do you make of that?
So yes, almost $15 billion have come in across quite a few deals, and we have seen investment in both the NBFCs and banks, mid-tier banks and obviously large-size NBFCs. Great for the sector, the fact that they're seeing Indian financial services markets as a place to invest in. I think it's just ticking the box for what the opportunity presents. A lot of these players maybe are seeing lesser growth in some of the markets they operate in, and they see India as a long-term opportunity. Great that they've got this capital, they've got this big brands behind them, so they don't have to worry about capital going forward in the future. But financial institutions are the most leveraged institutions in the world. You get the capital in, but the real balance sheet growth comes only if you get the deposits in. So, given the size of some of these institutions, getting the deposits in will remain the tough thing they need to execute on. And while a lot of these brands might be well known outside of India, they're not necessarily that well known in India. So that brand per se is not going to help you. Yes, you have more firepower now. Yes, you have more staying power now. But ultimately, getting the deposits in India is going to be hard grind all the way.
Well, I'll get to the hard grind on deposits in just a second, but if I were to read between the lines of what you're saying, you're not really worried about competitive intensity increasing on account of these banks being able to get in the kind of cash that they have?
Well, we have to worry about the competitive intensity in India, so this is just add to it. Are we extremely worried? Well, we have had cases where some of the foreign players have come in and invested in India in the past, and I don't have to say more. I mean, it's very evident in terms of what they've been able to do. That does not mean that's exactly what will happen in the future also. We have to watch them closely. I'm sure one or two institutions might be able to kind of get over the hump and really create a large global bank or large Indian bank. I do believe the Indian economy has to grow to the ambitions it has. It needs not 5, 6, but at least 10 very, very large banks. So I hope some of them do upgrade themselves. But it is not going to be easy.
Well, let's then talk about the hard grind for deposits. How much has changed on that front? Because the last time that you and I spoke here in Davos, this was the big story, this was the big theme, that it was getting harder and harder to mobilize deposits. It's showing up in the numbers. How much of a hard grind is it likely to be going forward?
So, since the last time we talked, obviously RBI has very openly stated that they will provide durability in the system, but I think they do need to do a little bit more. We have had cases where the liquidity has kind of almost gone away because RBI has been in the markets. So durable liquidity means constant, continuous liquidity in the market should be able to buy into it and act accordingly. That's one. Secondly, the credit growth has picked up, but let's also realize that government balances with RBI remaining extremely high. They are at some of the highest we've seen in the recent past. So the deposit growth is still taking more time to come through. If you look at some of the numbers that have been published, they remain in the 10 to 12% range. People have started talking about credit growth of 15 to 17% for next year. Well, as I have said in the past, if credit growth is 15 to 17, deposits need to get there at some point in time. Both cannot diverge. So obviously, RBI.
But do you expect this divergence to widen?
I don't think so. I'm just saying that RBI, if they want the economy to grow, if a lot of measures are being taken to ensure that this 7.4 is a given and you kind of deliver some similar number next year, the economy has to grow. That means it has to be funded, which means the credit growth has to come back, which means that at some stage people do need to catch up, which means that RBI obviously has to do more than what it's doing.
But forget what the RBI has to do. What about banks?
Well, when the deposits come in, the system will get a fair share. The problem is not that deposits are lying somewhere and we are not able to capture it. The problem is twofold. One, the deposit growth is where it is. Secondly, the nature of deposits for sure are changing, because as Indian retail investors go and invest in the stock market more and more, the deposits that are coming back in the banking system are in the form of wholesale deposits rather than retail. They have a price.
So you're saying even if you were to hike deposit rates, it wouldn't really make a big dent or a difference as far as deposit mobilization is concerned?
Yes, just hiking deposit rates for retail deposits necessarily does not make much of a difference. Because the wholesale deposits are priced at the market and the increment all the time. They literally, the large ones bid it out, and so the market pays what the market is willing to pay at that point. And there will be some banks who will always be desperate, so they might pay more than what the market is. So that is something which is pretty much a given. But yes, the overall deposit growth is still a bit of a worry, and we do need to get it up. Obviously, RBI is aware of what they need to do, so they're working.
That brings me to the question that I last asked you here on the LDR ratio, and at that point in time, the RBI was asking questions of banks. Has there been a pullback on that front?
So yes, RBI has stated again openly that LDR is a question they're not asking that much. Our experience is that yes, the number of questions being asked on LDR has come down. Anyway, we have maintained the LDR at the same levels for the last 7-8 quarters. But I hear from the banking system that RBI is not pushing as much as LDR as before. You're also seeing that the public sector banks, which had much more headroom on LDR, have gradually been increasing their LDR ratios. So there was a recent article about how we were at a peak LDR. Given the nature of deposits, given the kind of balance sheet a lot of us have created, LDR might not be the only way to look at the liquidity in the system or how deposits are linked to the amount of credit you're giving, because we do refinance, we do infrastructure bonds and all of that, and they don't necessarily get counted in deposits. So I think my view is that RBI will be watching it closely, but that will not be the only parameter they will be watching.
You talked about credit growth inching towards 15 to 17%. But we've been talking about this private sector investment capex cycle picking up and the green shoots. Where are the green shoots today? Are they bloomed or not?
So if you look at the private sector, I mean, just the overall growth, if you look at the numbers on a nominal basis, the numbers seem to have actually come off, because maybe there was a bit of a front loading which happened before the tariffs kicked in and the prices of some of the goods were reduced. You also have the last year base effect of telecom and energy. But on the real basis, the growth continues apace. Are we seeing the private sector suddenly coming out and saying, I'm going to now invest at a completely different level? Not seeing that as yet.
No. Any stress, any vulnerabilities in any pocket that you're starting to see at this point in time?
No. I think the overall actually asset quality on the retail side is turning around and it is stabilizing. I think the results of the banks continue to exhibit that. People were a little bit worried about the SME, broadly the SME sector. I think the banks are not seeing it as yet, and obviously all of us are watching our portfolio very, very closely. The wholesale side has been quite benign. Wholesale side has not been borrowing that much either. So in that sense, wholesale is benign, SME being watchful, but no signs as yet, and the retail side is actually really turning around.
So what's the outlook then as far as margins are concerned for you?
Well, the net interest margins, as we have stated in our various calls or during the silent period, interest rates have been cut by 125 basis points. We have to pass on the entire interest rates benefit to the customers. We haven't got we are not able to recoup the entire amount from our customers in terms of passing on the cost of deposits. So it will take some time. But you are seeing NIM stabilizing, or they will stabilize soon, and hopefully from there on they should start reaching upwards. So For some banks it has already happened, some banks in the process of it happening, but hopefully in the next 1 or 2 quarters, the graph should start moving up.
Let me also ask you about what you make of the currency movement, and we've seen a very, very rapid move as far as the rupee is concerned, almost at 91. How are you what are you factoring in as far as the currency move is concerned?
So, there is a concept of real effective exchange rate, and as per that, rupee should be 2085 rather than 1991. Obviously, what the current currency rates reflect is the fact that FDI in India is not coming in, so there is a pressure, and as a result has gone to where it has gone to. That's why RBI has also intervened, because they are happy for rupee to slide, but they don't want these sudden spikes. What the real rate would be 10 or 12, 18 months online, I don't know. But the effective exchange rate is 85. Whether the rupee will appreciate, difficult to predict. But I would say hopefully it will stabilize from here on.
At these levels.
Yes.
Okay, FDI, and you said that there is a lot more that needs to be done. The government has taken measures, but a lot more can and should be done. What specifically would you like to put on the table?
Well, the government has already done a lot in terms of GST, and they have talked about large amount of investments. They've done the PLI scheme, they've done the GST cuts. So there are only that many things which are left in the armor of the government. But at the end of the day, if private capex is not going to come into, government has to continue to scale the capex on the government side. I think we have to do much more on the R&D side than what we've done as a country. I think we are lagging behind some of the other players. And if we want to come out of the middle income trap, that is a specific investment on a sustained basis that has to happen. Private sector, if you look at the R&D numbers, we don't compare with any country out there, right? We're in the 0.6, 0.7% GDP range, others are 2.5% above and above. So in that sense, R&D would be one area. One more area would be that MSMEs also need PLI-like schemes or credit support in form of credit enhancement. My view is that again, government should scale that to a completely different level to support the economy differently.
Rates?
Interest rates?
Yeah.
Oh, I would say interest rates would have stabilized. If you look at the inflation, it is inching up to 4%. My view is that somehow we are caught into this, it has to be between 2 and 6, so it is at 4. I think India should allow a slightly higher inflation, because if we want to support our economy, we can afford a little bit higher inflation. So my view is that interest rates are pretty much done with.
So that's the end as far as the cutting cycle.
I wish so. Yeah.
You hope and you wish so. It's very rare that you actually hear somebody say that. But let me end by asking you, so much of the conversation here in Davos, of course, when we're not talking about Trump, it's about AI. How much of that have you been able to incorporate within the bank? How much of agentic AI are you using at this point in time?
Oh, it has been a huge area of investment for us over the last 18 months. Investment first in terms of looking at what AI can do and how we can take advantage of it. So real dollars have not gone in, but in terms of thought process, management, bandwidth and so on and so forth, we are working across the entire enterprise on enterprise-wide AI projects and business-wide AI projects. I do believe it will make a huge difference on the cost side, but I'm more hopeful and looking forward to actually AI making a difference in terms of how we can increase our revenues differently by, can I find pools of customers which we're not been able to cater to this point in time? Can I reach them more effectively? So on both the sides of the P&L line, we do believe AI will be huge, and as any large institution, we need to be investing in more than what we're doing today. That's exactly what we're doing.
How much? Give me a number that you can leave us with in terms of what you intend to invest on AI.
Well, we spend about 8 to 9% on our IT costs. Okay. That number will remain quite large.
Amitabh, always a pleasure. Thanks very much for joining us here in Davos, giving us a lay of the land of what the banking sector is looking forward to in 2026. Our conversations will continue here at Davos. Don't go anywhere. But back in a moment, we'll be joined by the Global CEO of Franklin Templeton, Jenny Johnson, right after this break. Thank you, Amitabh. Thank you so much.
Good to see you, I'm sure.
Good to see you. Yes, we're going to do a quick picture as well.
Sorry.
Thank you. Thank you so much. Hello, Jenny. How are you? Good to see you. Thank you for